Welcome back to Golden Rule Radio. And today is Wednesday, but by the time you'll be listening to this, it'll probably be Friday, right in the thick of March Madness, Week 16. And what about a 16 seed knocking off a number 1 seed? You know, that shows that just about anything can happen. Somebody can rise up and dominate a team that probably should be in the Final Four. And, you know, what does that mean?
That means that Mexico, the 16th-ranked GDP in the world, could actually have a better year next year than the U.S.?
Oh, no, related to metals. Yeah, related to metals. I mean, when I think about buying gold or silver, it's not a Mexican coin that I first think about. Although, there are some really neat Mexican coins that are out there on the market. If you're interested in them, we sell those as well. But, you know, Mexico, it's not the first gross domestic product that you think of when you think about the world. And whatever that no-name 16-seed team was, sorry for people if they went there, you know, they knocked off the team that a lot of people had going all the way. Okay, what else happened? Oh, the Fed raised the interest rate 0.25%. You know, we were just sitting here talking before we started recording, and it's like, why not 20 basis points or 33? Or something other than a quarter. I'm just tired of seeing that a quarter is the expected. They're expected to raise it 3 or 4 times this year. Ooh, everybody look and watch. Everybody pay attention to every single word that the Fed says. And every little quarter point interest rate. Why are they only raising the interest rate 0.25%? What do you think?
Well, everybody's looking back at the smarter predecessor we had in Alan Greenspan, who, when he was stepping the interest rates down, leading into the real estate collapse. So I guess smarter is an arbitrary term. Those were quarter point moves about every quarter that we had coming out in 2004, 2005. So I guess maybe if you step out the same way you stepped in, somehow that's going to even everything out, and we'll be able to wash our hands of the last 15 years of mess that we've had in the U.S. markets, and just pretend that everything's fine and dandy and pick up where we left off in about 2003, 2004.
You know, Miles, I also think that it shows exactly how sensitive the equities markets are to interest rates, and they are aware of that, right? And so if you step it up too aggressively, Robert, to your point, you're going to rock the markets a little bit too much. They come out with some hawkish sentiment. If it's too hawkish, then the market turns down more aggressively. We already saw it from peak to trough today in anticipation and then in obvious reaction to the final decision, moved 268 points from peak to trough. So that's still volatility. That still is an aggressive reaction to the actual news. Imagine it would be at least twice that if you had come out with a half-point move.
Tori, earlier you were saying something about one of the newer guys here at our office was asking about, in the past, hasn't a rise in interest rates been dollar positive? You know, hasn't that been showing strength to a currency if you raise interest rates? And maybe you want to run with that one, but I do have to point out, as we've pointed out previously in the show, the last, 4 interest rate rises by the Fed going back to December 2015, that has been the bottom in the gold market cycle. And just yesterday or overnight, whatever you want to look at it, the gold price from Tuesday this week to Wednesday this week, we just bottomed again. So the market was expecting the interest rate to be risen today, as it was, and here we are. We just, looks like we turned a corner.
Well, the anticipation you mentioned too, with pretty much everything up this morning, Wednesday morning, leading into the Fed announcement, gold's up, oil's up, the Dow was up. But as soon as the announcement comes out, the Dow's down. That's what you were mentioning a second ago.
And the dollar.
Well, of course, the dollar's down with interest rates coming up. But the Dow turning down after the announcement is fascinating, because what that tells us is that the value of the equities market, which everybody in this room knows and probably all of our listeners know, but the value in the equities market isn't based around the values of the companies that make up that equities market anymore, not at the price to earnings ratios we're at today.
That's right.
The equity market value is made up on speculative investing and borrowed money.
Amen. That borrowed money, it is a credit-driven cycle, right, that we're in the middle of. It's a credit-driven market. So back to the question that Robert asked, you don't want to contract borrowing too aggressively on too aggressive of a rate hike. That is what they are putting all of their eggs in. That is the basket that they're hoping turns around the economy. They're projecting 2.7% growth this year, 2.4% growth next year. but yet they want to raise rates because they don't want the economy to overheat, right? Well, what is that? That's inflation? Yeah, well, you just drove the dollar a little bit lower still. But to the new guy's question, it used to be, yeah, you raise an interest rate, that's strong dollar policy.
Right, or for any currency.
For any currency, that's right. And yet everybody knows now that because of what's driving these markets, it's actually going to have the adverse effect and drive the markets down, drive the currency down, drive gold up, to Robert's point again. Subsequent forward climbs after those reductions.
Yeah, but that system hasn't worked in quite a while because we're no longer...
I think that's the point. Right?
Yeah, no longer a global economy that cares about having a strong currency. In fact, quite the opposite, so that you can be more cost competitive in your exports. So having that lower valued currency, while in the long run does more damage than good, in the short term, certainly for a couple terms in Congress or presidents, you can increase productivity, maybe even increase your exports for a period of time by lowering the currency. It ends up costing all Americans a little bit more money without us knowing it because our local cost of living increases faster than our income does. But it feels like everything is getting better, at least for the short term, because we're selling more goods and services, we're putting more people into work, we're lowering our unemployment numbers, but we're really not gaining any ground. We're just spreading the wealth out around a larger number of people. So it kind of brings everybody's cost of living up. It brings everybody's standard of living down slightly at the expense of, well, the value of our currency and our cost of living down the road. So here within the last week, we've come across an article on marketplace.org titled Panic, Fear, and Regret, which all three of us are going to fight our way through over the next couple days, and you can definitely head over to marketplace.org and grab a copy yourself. So, and it's a historic conversation with Timothy Geithner, Ben Bernanke, and Henry Paulson, who you're talking about a couple of guys who inherited a financial experiment that began before them, weren't created by them, caused a mess that they now have to clean up, and they didn't have the tools to do so. So at this point, we're still seeing the tail end of that experiment. So the question ends up being, of course, are we going to revert back to the things that we know how to deal with? Or are we going to come up with a whole new financial experiment to try to patch the last financial experiment that was a patch on the last financial experiment?
I think that's right. And to your point, we were dealing with trying to put out a fire without the right tools to do so. I go back to what we said last week, and that is that they are raising interest rates in order to put that tool back in the toolbox. They didn't have that tool.
Right.
Interest rates were too low.
Right.
They couldn't lower them aggressively enough to stop the madness. Geithner, good subtle question. The enemy was the fear and the loss of confidence and the sense of no bottom. That's what they were attacking, is that fear mindset, right? And the tendency is to rush for the exits to protect yourself against the harm to come. Well, that's true. That's what gold does better than anything else, is it protects us from that, right? You're already diversified going into a fear-stimulating crisis. Don't wait till it's too late to do that. We can speak to that from back in 2008 and 9 when everybody was trying to buy metals and premiums were skyrocketing. Everybody was excited because the price came down initially. It didn't matter. The physical market didn't adjust. You were looking at 40% premiums on some silver products.
Well, the key word there is, I think, regret. I think Virginia has some regret this week. University of Virginia losing that basketball game. They go down in history. And then you have these monetary authorities who have regret, or that wouldn't have been in the title. So as we go through this article, we'll find out, what they say. But regret is not a fun thing. All of us, I think, have experienced that at some point in life. I think that's just part of living. So the important thing here related to the metals market is don't have regret with seeing a trend that we on the show have identified for you. December 2015, December 2016, whenever the next interest rate rise was. And then today's Wednesday, every time you've had the last few rate hikes, every time that's been the bottom of that gold market cycle. Here we are again. This is an opportunity, very calmly speaking to you, saying we had a turn last night in the gold market. It didn't break below 1,300. Here we are. We're going higher. It's up today. I think we're on the way north. You guys?
So Robert's calling 1308 as the bottom. Does that sound like that to you, Miles?
Nah, not calling the bottom, but just saying, mark down history, mark down the trend. We've identified it for you. Here's your opportunity. You've got low premiums on the double eagles, historic low premiums on those. And here's your opportunity with the gold price marching higher. It's going to leave you behind at some point.
What do the technicals show?
Sure. I think looking at the charts, I mean, we're all building off of the December lows to the January highs. Robert a couple weeks ago pointed out the 50% retracement line, which we came back to at the beginning of March. And we've made a couple pushes, attempts to get back above 1340. We're on the second one now. So I'm going to agree. I think that if we can get above 1340, we're definitely off to the races to the actual longer term high water mark. We're looking at 1375. If we don't get above 1340, I still think sub 1300 is possible. We've got the 618 fib at 1285. I've been saying 1285 for a month now. So it's completely reasonable. We could see sub 1300 if we can't push above these levels.
That would be like, though, buying gold at either 800 or 850. Okay. Yes, I would have rather bought it at 800. But if I bought it at 850 also, like buying gold today at 1320 or whatever, you're then now from 850, you're at 1320.
You forget all about 800.
You don't really care that much.
Right.
So, I mean, we're talking about small numbers in these market moves, and I think Miles probably has a little bit more technical savviness than I do. So maybe we see that little pullback. I hope we do.
But keep in mind, that can take a long time, too. We're not saying days, right?
Yeah.
We may not see, Miles, your new high for 6 months, 8 months, right? This could be a sideways trend here for a while. I mean, what are you thinking?
Sure, but you can also see it in a week.
That's right.
Too.
Yeah.
Because we're not talking too far off. I mean, we're talking 30, 40 bucks at this point. So moving over to silver. Silver had a big day, up 47 cents today, Wednesday, on the Fed announcement.
Huge.
It was pretty huge. Although silver...
Almost 3%. That is huge.
Yeah, it's pretty big. Silver's sitting right in the middle of its compressing pennant that we've been talking about. I've been harping on for a while. I mean, that's been building for
That's why we've been on the sidelines watching, as we said a few weeks ago.
So when that floodgate opens, when we get to the end of that pennant, or it makes a breakout direction one way or the other, that also will be huge. Both platinum and palladium had okay days as well on Wednesday. Platinum up 15 bucks today, 10 bucks on the year, back above its 50% line from the December to January move. I would argue we're stepping down to the fib levels at 935 because we're coming into that with divergence. And I think for anybody who's still waiting for that platinum play, if you see platinum in the 930 to 950 range, get on the phone, pick up a few ounces. Finally, I think the last thing to mention is oil, because oil has had a heck of a week, up about 7% in the last 3 trading days. Commercial inventories down. They were expected to go up. They went down over the last week. And also with interest rates coming up, as well as possibly some of the tariff news, maybe looking at spending some of our own inventories with maybe some concerns on oil import tariffs coming around the corner. That's always an issue, or nowadays certainly could become an issue. Oil also pushed back above the 65 mark, so we could be seeing a new high in oil if we can get up to like 67, 68. And then finally, looking at the Dow was up leading into the Fed announcement on Wednesday. We talked about this earlier in the show, back down following. We talked about the reasons why, having to do with our current equities market being inflation-driven, not reality-driven. And finally, I don't know if I'm going to see the dollar get up to 92. I'd still love to see it up there. It's not going to happen. I don't think we're back below 90. And if we push below that 50% line, I think the dollar's going through the floor.
Well, with a president who wants a weaker dollar, a U.S. Treasury Secretary who wants a weaker dollar, by the way, I don't trust that guy, and then by having a lot of the rest of the countries in the world trying to collaborate together to, take away their dependence on the dollar, how can you argue for a strong dollar?
How low can it go?
How low is it going to go?
Well, thanks again for listening this week. We're going to call it a wrap.
Enjoy some March Madness college basketball. It's a lot of fun to watch these guys. It's a good distraction. And have a good week.
Thanks as always. Hit that subscribe button, ring the bell to get notifications. Head on over to our website, McAlvanyICA.com. You can catch us on Twitter at ICA Gold or call us anytime, 1-800-525-9556.